Hello, good afternoon, everyone. Welcome to the third panel around carbon pricing. Let me just get some headline introductory statistics out of the way. So from World Bank's State and Trends of Carbon Pricing report, we have about 80 carbon prices globally implemented, covering about 30% of global emissions with about $100 billion in revenue, right? But coverage is a big win in the past decade. The tougher discussion is around price ambition. Emissions covered carbon price average only about $5 per ton, right? And so we have finally three great panelists from a carbon standards, project developer, and also from a regulator. Like, let me start with Mandy. So Mandy, as CEO of Vera, you've looked at the landscape of carbon prices globally and where countries and compliance schemes are looking at both the use of taxes, emissions trading schemes, and carbon credits. Could you share a bit more around some of the developments and how regulators are looking at the mix, particularly in the global macro headwinds that we are observing today?
Sorry, Anshari, can you repeat that last part?
Could you share a bit more about the developments that you're observing globally around carbon prices and how regulators are looking at the use of a mix of both emissions trading scheme, carbon taxes, and also Article 6 in their scheme?
Great, thank you. Thank you, everybody. Thank you to GenZero for this magnificent conference. That's an interesting question and a very good question, and something that I think is extremely important for climate action. And I love that video. I said to someone that GenZero clearly has a young marketing team. It's a fantastic video. But one of the lines on the video said 1.5 is slipping away. And 1.5 is slipping away due to lack of climate action. So what we're seeing is there are areas or countries in the world where carbon pricing has been seen as the instrument that is required to actually meet climate action. So if you look at the State and Trends report from last year, from 2025, we haven't seen the 2026 one yet, 2025, it shows that there is a growth in the number of carbon pricing instruments around the world. So we have regulatory instruments, whether they're carbon tax or emissions trading schemes, ETS, and then you also have what is coming in as the voluntary market. I don't see these as a tension between compliance and voluntary. Maybe at some point there was a tension between the two. But if we look at what happens in terms of carbon pricing and what is required to meet the 1.5, there's this crazy number that goes around that's about $8.4 trillion needed per year by 2030 to reach 1.5. And if you know what $8.4 trillion looks like, it's a lot of money. And then after that, it's $10 trillion. So we really can't have this tension between voluntary and compliance. We need to see how they complement each other. And I think that is what we're seeing more and more in the world. So I'll give you some examples. I think what has happened in your country, Anshari, and in mine has been very instructive in where you have...
Where are you from, Mandy?
Say again?
Could you share a bit more which country you are referring to?
Where I'm from, South Africa.
Yes.
Okay, so I forgot for a second. So I think it's, I'm jet lagged, guys. So if you look at what's happened in Singapore and what's happened in South Africa, is there were carbon taxes implemented, a compliance scheme, but what the regulations have allowed for is the use of a voluntary credit, like a Vera credit, to meet that compliance scheme, which really is a coming together of a compliance market and a voluntary market. But what's important for that to happen is that I know we started carbon taxes in Singapore, also in South Africa, and Colombia is doing the same thing as well, at a very low level, but that was to get it going, right? To get companies in, to understand that this has to happen. But in order for the market to deliver what it needs to deliver and for us to have climate action, those compliance prices will have to increase so that we're not left with cheap voluntary credits that people are buying to meet their compliance. So I think it's not a tension. I think it's a complementary relationship and something that we need to build on. And like I say, we still don't know what's going to happen with the EU ETS, but that could be a large portion of that demand as well. The China ETS is growing, and that's also going to be a large portion of demand. No link with voluntary markets as yet, but perhaps that's coming as well. And then on the other side, on the compliance, we have CORSIA. And I think COSIA is also a huge part of the demand. So there's no longer this voluntary carbon pricing and regulatory pricing and compliance pricing. I think it's all coming together and in a good way for us to meet the climate action that's required.
You've raised a couple of points, including the EU ETS, which is currently being reviewed, right? Let's park that potentially for a second part of the conversation around different schemes, pricing, and how they might interact with Article 6 and credits. Maybe I'll go over to Angela.
Sure.
Right? You deal daily on transactions in both the compliance and the voluntary carbon market. We've kind of touched a little bit around how the different compliance carbon pricing schemes are, right? And that's really regulated markets. But the CDP data also shows that corporates are introducing internal carbon prices at $130 per ton, which is potentially higher than even what the compliance schemes are putting out, right? So how do you see this disconnect between how corporates and companies are pricing carbon and how they're looking at carbon, and what could be the policy ask there from the different regulators and compliance schemes?
Yeah, thank you. When you think about the carbon market pricing, we have two distinct prices in the market today. One is on the compliance market. We've got about 30 to 35% of global emissions are covered under a pricing scheme, either a tax or a traded market. And then we have the rest is in the voluntary market, which is distinct and separate from what happens at a corporate market. So when you think about the first segment, we're pricing right now anywhere between 10 to 30 is about the price signal on a compliance market. In the voluntary markets, we're slightly higher. We're pricing maybe 20s to 50s is where the voluntary market seems to be comfortable. When you get to the corporate market, it's really a shadow price, and it's used for very different purpose. It's used for planning. It's used for budgetary. It looks at things like what is the reputational risk? If we don't do that, how do you price that in? So that shadow price right now is anywhere between 50 to 150. And that's still, in my opinion, it's still on the low end. So when these three prices have to exist in the market, two things happen. One is that there's a credibility discussion, which price is the right price. And obviously, depending on what side of the market you're on, you tend to want and hope that the lower end is it. If you're looking at policy, I think it's important to be able to point to the shadow pricing that's used by the corporates to move the market up to where we need to be. Mm-hmm. So I think they coexist. There's going to be a conversion of pricing. And when we look back over from 2022 to where we are today, we've had a fundamental shift in what's become important. Price will always be a driver, but as we know, we've for the last 3 years, I think everybody's tired of hearing it, we've had a flight to quality and integrity and that whole aspect that's driving the prices up. So I think that's how those prices sit together in the market.
That's great intervention, thanks. And I think today we are also seeing the cost of doing carbon projects, the unit economics actually quite high, right? With new methodological updates, are carbon prices actually keeping up with what is actually demanded on the ground in terms of setting up and originating some of these projects. But let's now turn to Matt, right? As chair of the Climate Change Authority in one of the most watched domestic schemes globally, right? There is an argument out there that it's not just about the headline price. Yeah. It is about the design of the system, how the caps are allocated, the baselines are set. Could you share a bit more from Australia's experience with the safeguard mechanism?
Yeah, well, firstly, thank you, Anshari, and could I just give a shout out to Fred and the whole GenZero team. I mean, Fred's one of these rare people that doesn't accept the false choice between doing well and doing good. In fact, he's built an entire business around it, strong commercial returns, strong climate impacts, and that takes real conviction. So I just want to say a massive thank you to Fred and the whole GenZero team for pulling us all together. And I just want to say that GenZero's success is our planet's success, so keep going. Thank you very much. With regard to the, I guess, headline price, is that where it's all at? Let me tell you about this Australian experience. It's a long and troubled history around carbon pricing. Some of you may remember we had a carbon price in Australia. It was repealed. My message to those in the room is that a carbon price that gets repealed achieves nothing, but political durability of policies is far more important. And from the carbon price, what was left in place was something called the safeguard mechanism and the ACCU scheme. And that has survived several political cycles. Now, it's not a single elegant price, it's fair to say, but we shouldn't make the perfect the enemy of the good. It's politically durable, and importantly, it's increasingly trusted. So the safeguard mechanism works because it gives industry a clear trajectory. So facilities know where their baseline price is heading. That forward certainty drives investment, not the spot price in any given day. So again, it's not a single element price, but it is durable and it's trusted and it's working. So that's been very important. It covers about a third of Australians' emissions profile, and it's got a ratchet rate. Investors know that that will continue to come down to 2035 and ultimately to 2050, and it will take care of about a third of Australia's emissions, and it has broad political consensus.
And could you share a bit more, perhaps, what can we expect from the review that's going to happen this year, if you could?
Well, I'm sure it won't leak the independent review that I'm conducting as the chair of Australia's Climate Authority, but what we want to do is build on the scheme that is currently in place. So we don't want to throw the baby out with the bathwater or start again. We're going to build on the existing policy frameworks. So what does that mean for investors? It means that the policy settings will be durable and there for the long term. The government has made a very clear commitment in Australia that the safeguard mechanism is here to stay. There is a pragmatic pathway for big polluters to decarbonise their kit or to buy offsets. And it's about getting that price right that gives businesses that don't have an affordable decarbonisation plan a pathway to do their bit for the environment and continue to operate in Australia, but with a price signal that ultimately encourages them over the long term to decarbonise their processes. Once the green premiums are down in an affordable place, then they move from carbon crediting to actually decarbonising. That's the system working well.
That's great. So let's move on to one of the other systems that Mandy you've mentioned, which is the EU ETS, right? I'd like to get perspectives from all the panelists, if possible. Now, there are clearly two tensions at play here. One is maintain the ambition and the biting, how biting the allowance caps are, right? At the same time, how do you manage that against the competitiveness of the industries and against the broader macro headwinds? So what do you think is probably one or two of the single most important factor or consideration, right, in terms of a policy unlock that will actually support broader decarbonization, maintain ambition level, but also potentially allow for more flexibility for EU to open up to international markets?
It's a great question. I think that the tension, again, I like that word tension today, obviously, but the tension that exists currently is the question of if you allow international credits, if you allow offsets, does that draw corporates away from doing domestic action? So I think the one unlock to say is absolutely not. Domestic action comes first and is always the top of what you can do, as much as you can do domestically. I think regulations, governments make that clear, and that's understood. I wouldn't then restrict, from a regulatory perspective, what type of international credits you should have. I think what you should restrict is making sure that they meet a quality, a high bar standard. So say, for example, if you're using a Vera standard or one of the other international crediting programs, they have to meet the ICVCM bar. So that gives you sort of a floor of what you need to meet. So any restriction on how you use international credits brings on the risk of concentration risk. If you have a restriction on the type of project, you have a restriction on where and how it should be used, you then run that volume risk and you run the concentration risk, which I think will stifle the market. Again, what are we trying to solve for? We're trying to solve for not exceeding the 1.5 goal and what are the things that will open up the market the most is being very clear on this. So the policy decisions have to be very clear. They're domestic first and then use international credits. The other tension is sending your money internationally. Should we be spending our money internationally on projects in countries outside our region? And again, if you're doing all you can do domestically and you cannot meet that last 10, 20%, why not use the external the market outside your country, the international market, to meet that? And when we talk to corporates, they say, if we are restricted in buying international carbon credits, it does not mean that we're going to use those dollars within our country, because we've already done all we can do internationally. And so I think those two restrictions or those two tensions need to be talked about and be very clear about and remove that uncertainty so that we all understand that. And also, the other thing is that if you are investing, say you can't meet 5 to 10% of your climate action domestically and you want to use international credits, that dollar spent internationally in a country, say in Ghana, Malawi, Zambia, Laos, any of the least developed countries and developing countries, you have far more impact per dollar in those countries than you would if you had spent that domestically. So what happens is, if you are able to do that, you are able to then not only deal with decarbonization and fund decarbonization, you're also funding growth and economic development in developing countries, which is ultimately what we started out trying to achieve. So I think if we're very clear on that regulatory landscape, we're very clear on spending money on international credits is not going to hamper your domestic action, that will be a big unlock in the market.
And I think the key there, as you mentioned, right, is what is the last mile, right? So what is your best foot forward in terms of the ambition, what you can do domestically, and what more you can do? I'd like to get your perspective on that, on how you're looking at developments globally and where ANU is seeing new opportunities, where you think you can potentially participate in schemes where there is a pricing scheme and design, as Matt has already mentioned earlier, which is credible, strong, but is also looking forward into delivering impact beyond its boundaries. And maybe to Matt, right, what about Australia? Right, so EU has communicated that it's going to use Article 6, 5% in 2040, right? How is Australia looking at the international carbon market, Article 6, in terms of participating? Potentially not near term, but potentially mid-term. So maybe I'll turn to Angela first. Any views on that?
Are you asking me about Australia? Or
No. on how you're looking.
No, I'm happy to answer, but no. So yeah, it's stating the obvious. It's a very complex market, and for us, we were North American based for a long time. And you think back in 2020, 2021. North America was leading the world in being ahead in all of its processes around decarbonization. Embarrassing to say, that is no longer the case. And so for us, first and foremost, as a for-profit company, we had to pivot to markets that we think were viable. And we've been really pleased, and it's been an eye-opening and a really reinvigorating experience for us to work within different countries and under different regimes where the appreciation for the task and mission at hand is very clear. And we are for-profits. For most people in the room are for-profit companies, and we have to be able to make money to continue to do what we do. But at the same time, we have arguably the most important mission out of any industry. And while I appreciate everything that's happening in the tech world, this planet has to be viable for all of us to be on it, and we can't lose sight of how important it is. And we get, sometimes I get frustrated with the slowness in the market. It's a high-friction, slow-moving market that has a train running at it, and so those two need to coordinate better. But I do think that the schemes that are rolling out, there seems to be more continuity. There is more of a common language that's now being spoken. There are organizations that are looking for standardization so we can move fast and we can move globally. Article 6 is complicated in its execution. I would have preferred a more simple market-based initiative that doesn't require so many counterparties having bilateral agreements so they can get the credits then into the market where then they can have a capital market take over. But it's certainly an improvement over what we had. And I think it was the opening speaker, Martin, and I apologize, I don't remember his last name, where he quoted both the K-pop band and Martin Luther King in one statement. But to me, that really resonated well. And so while this may not be the ideal rollout for Article 6 in looking at how we're managing global emissions and global trading, we're past crawling, and now we're starting to run.
Mm-hmm. Very good.
On Article 6, the Australian government has ruled out opening up international credits for use in our domestic compliance market. They've just given terms of reference to the department and to the Climate Change Authority in terms of the scope of the reviews that we're conducting into those schemes, and explicitly it is excluded looking at Article 6 and how that might be used domestically in Australia. And that is for good reason. As I said, the Safeguard scheme, the ACCU scheme in Australia is trusted. It has broad social licence across the community, and the last thing that the government wants to see is undermining that because integrity questions are being raised. We've just been through a long process of reviewing how ACCUs work, the right methodologies that are appropriate in Australia, that were brought into question by a convergence of two ends of the political spectrum, the deep green movement, who don't want carbon credits used, and the Trumpian right, for want of a better word, who don't want carbon credits used, came together to try and undermine the whole system for different purposes, but with the same objective, to get rid of the Safeguard scheme and the ACCU scheme. That has held up. The integrity matters of the scheme. It has been protected, and largely Australia is moving forward with the current settings that we have in place.
Excellent. So different approaches for different countries with very varied considerations around leakage, around revenue, and keeping the system integral. I'd like to go into the Q&As in a bit, but perhaps I'd like to go back into this question that we kind of skirted around, which is around as projects become more expensive to develop, right? How are you looking at what is the ideal price ratchet scheme globally, right? To incentivize in schemes which allow for the use of carbon offsets using new methodologies. What is your vision for how the carbon prices would potentially increase in ambition and credibility to reflect the investment that is needed to get into the transition that we need? It's a very difficult question, right? Yeah, I'm just wondering if there's any views from the panel.
None.
I think I can offer some thoughts around it. What we find is that there's a lot of studies out now on higher quality credits fetching higher prices. So higher rated projects fetching about 4 times more in the market. And so if you have a COSIA label, if you have an Article 6.2 label, you get a higher price for your credit. I think what needs to happen, the carbon market is very marginal right now. If you look at all that needs to happen, you have project developers that need to get paid, VVBs that need to get paid, the community benefits. All of those things stack up. So for the carbon market to be viable, you actually need compliance prices to increase so that the voluntary market prices can increase as well. Mm-hmm. And when we talk about bringing those two together, that's what needs to happen. So the price does reflect high integrity, high quality, and so we need that to increase as well. What is probably required is some sort of standardization on that quality bar. So if we're saying in the voluntary market that the ICVCM is how we are judging ourselves as the floor, and anything better than that is even better, I think all schemes need to look at those kinds of principles to judge themselves as well, so that we have that bar of quality and then we have higher prices in the market. So a little disappointed to hear about Australia's view on using Article 6 credits, but obviously that's something that's, like you say, domestic action first. Yes. And if you feel you're not going to use international credits, but I would just push back a little on questioning the quality that's coming out of the international market.
And I accept that, but I guess we're trying to get this mechanism working against what is a very political backdrop.
Yeah.
And it's about
Yeah.
making sure that there's broad public support for the systems and processes that we have in place that need to get us where we need to be, which is net zero by 2050. And that support is broadly there for the current system. We need to build on that. But at the risk of that political consensus fraying, we've already seen what happens in Australia. A carbon price was repealed, we went backwards, and that's not something anyone wants to see.
But I think the confidence in terms of Australia staying course on the safeguard mechanism is in itself a very powerful message, right? Even though you might not be looking at international credits for now, just making sure that that scheme stays in place and maintains the ambition, delivers the abatement is definitely a very important imperative.
It's durable,
Yeah.
and it's trusted, and it can survive political cycles. That's the focus if we want to actually do what we need, which is get to net zero by 2050. And can I just come back to your earlier question that you raised? I mean, what the system is ultimately designed to see is real on-site emissions reductions. So the price has got to drive that.
Yeah.
If the price is too low, then you'll just see compliance on paper, buying credits. So we need to make sure that the price is appropriate to drive that on-site abatement over the long term. And that's, I think the tell is going to be in the data. High credit purchasing, low capex decarbonisation. When you see that pattern, that means our system is not working. It's not doing its job. So what we need to see is a long-term trajectory around prices so that facilities who make long-term capital decisions actually will invest against that trajectory. So we need to get the right market signals in place, and a credible tightening trajectory is certainly more powerful than a high price today, and that's the Australian system.
And moving away from a spot market, so I've heard numbers from 1 trillion to 4 trillion, but it's a lot of money has to go into these markets and has to go fast, and the capital markets can't function in a spot market. And I agree 100% with your assessment that prices have to be high enough that it's painful and changes behavior. And right now, we don't have scarcity of credits in the market, and we need programs that create that scarcity, and comes with that as quality. But it'll drive behavior. We are in a situation where the planet is in danger, and we will be paying a high price to fix that. And so the faster we get to a normalized market where the capital markets can do what they do best, we're delaying it. And I applaud Australia for boxing in and saying, hey, it's working. We may not be 100% right, but it's working.
We're trying to hold on to it.
Yeah, right. Don't come here. We're good. We're good. We're going to demonstrate we can get this done. And it's frustrating. You have the standard setters who take 5 years to do a review. And then the review comes out, and it's not complete. And yet, we're being asked to invest hundreds of millions of dollars in a market that could be rechanged because the standard setters have rethought something. And that needs to stop. We need to execute. We've been at this for 20 years. There's not a whole lot of change that's come. If you think about what's different from 20 years ago to today versus the delay it's caused in the deployment of capital, we're not balanced right, and I hope that if there are any standard setters in the room, that any policymakers, that we need speed, we need stability, and we need scarcity, and the capital markets will take over.
And policy predictability.
Amen.
Thank you. And policy predictability, right?
And that's a stability, right? Yeah.
It's clear, right? So that's. And maybe that's good for investors too, right? To look into the Australia domestic scheme and the ACCUs.
Very much so.
Let me go into one of the questions from the audience. It's about greenwashing, right? This is quite interesting, and it's addressed to all panelists. What is your view on a permissible proportion or set of principles that buyer countries should be using to avoid optics of buying their way out?
you want me to answer that?
Anyone? So right now, in many compliance schemes, I think general range of what is permissible in terms of the use of credits. And I think in Australia's scheme, is probably the baseline against the use of accuse, right? It's about 5 to 10%.
The troubling word in there is optics. That's what troubles me on that question. It shouldn't be optics. It should be legitimate that if a company is making a commitment, they should be making it because it fits their corporate strategy, they're transparent on it. They shouldn't be judged on greenwashing if they're buying credits that make sense, have come through the registries, have been verified. I think we need to move away from the fear of greenwashing and
In short, if it delivers the abatement is real,
yeah.
no, there shouldn't be a limit.
Yeah. So can I say it's also, so principles, we were talking earlier about the regulation being very clear on what is needed domestically, and then you can add in international credits. So principles, I think, are things that we probably are gone beyond now, and I agree with Angela on the word optics being a bit, not the type of thing we're looking for, but to have real emissions reductions. What I was going to say on that is that what we have now is ways to prove that, which is digitalization. So you have data traceability, transparency, we have digital MRV that shows what real reductions look like. And I think all of that goes against this, oh, these guys are greenwashing, because you can actually now trace data. And there's so much transparency in registries and what projects are buying, selling, where all of that is happening right now. There is transparency. So I think the digitalization of that whole process will go a long way to helping the credibility of the process as well.
Okay, can I just jump in here for a second? Like, just remember what the objective is. We're trying to get to net zero, not real zero. Okay, as someone who believes in markets, we should be finding the lowest cost abatement first, exhausting that, and we go up the value chain. And I'm not talking. Australia is obviously sticking to its domestic settings and trying to unlock our domestic land sector to sequester carbon. But if lower cost abatement can happen in another jurisdiction, then why wouldn't we allow us to take advantage of that opportunity? We're trying to unlock the land sector in different jurisdictions around the world. Let markets work.
Excellent. All right, let's move on to the next question. It's a supply issue, and I think this is probably directed to Mandy around the different standards. What are your views on internationally accepted methodologies? Is there room for Peckham, COSIA, and ICVCM to speak to each other to assess and approve high-impact methodologies?
So I think, let me just read that quickly. I do think we need sort of, like I keep saying, this baseline on what is it that we accept as high quality. And I think the ICVCM has done a great job, tremendous job over the years to come up with those called carbon principles. And what's good about it is that they don't just assess the program, like ourselves, like Vera, they also assess each methodology, right? You have to pass that bar. So I absolutely think there's room for each of these bodies to talk to each other. And for ICAO and COSIA and ICVCM, there is already a lot of alignment. And I understand that they are talking with PACM as well. I think they absolutely have to have a common base between them, because when I was talking earlier about having this quality bar that nobody should go below, my fear is that if we don't align PACM with what ICVCM is requiring of the voluntary market, we are going to cross the line on that bar. So I'm not saying that one program is of low quality, I'm saying we all need to be assessed equally so that we don't contravene that quality bar. So absolutely agree that there's room for all of these to speak to each other.
And I suppose the bigger question is there's potentially confusion in the market, right? What is good and what is not? And how would probably a new look at that in terms of navigating where the demand is, where the meta standards lie, whether it's ICAO's, COSIA, or the ICVCM, CCP, or even PECM?
Yeah, there is confusion in the market, and again, there doesn't need to be. You're making a great point about the technology that's now available from a pure measurement and verification standpoint, and then the ability to transmit that information digitally and make it accessible and fully transparent. And as we continue to refine how that data is derived and how we're baselining and we're dynamic, we're not static any longer, we're not counterfactual, so all the things that really plague the market, and you know, credit to the demand side for calling the supply side out and making the supply side kind of wake up and say, okay, we don't have to do things in a static way, we can do things in a dynamic way. And using the technology that's available, and while AI will cause emissions to go up, it also will bring that level of speed and transparency, which will help unlock the markets. So, I think that we've moved past quality as being a systemic issue, and now we just need the trust back in the market to get people off the sidelines and buying again.
Indeed, and I think the key bottleneck or the key unlock now is demand.
Yeah.
Right, both on the corporate but also on the compliance side. And that probably brings me to the last closing statement and a view that I would like from each panelist. So the state and trends, the World Bank state and trends shows that we have built coverage, right? 80 plus carbon pricing instruments globally, covering 2/3 of global GDP, about 30% of global emissions. But the next decade is really about depth, not breadth. Yeah. Right? So we need higher carbon prices. Do you agree? Right? And what is the single most important lever, if I could put you on the spot, whether it's political, whether it's design, or whether it's headline price signals, to move carbon prices from where they are today towards the level that science actually requires?
Well, let me have a stab. Carbon pricing works when it's credible, when it's durable, and it's trajectory driven, okay? So it's not one of those items, it's all of them. So you've got to get design, you've got to get everything working together. And that's what we're focused on in Australia. The credibility, the durability, whether it be political or social license or whatever, but also that long-term trajectory. If you get those settings right, capital will flow and the abatement will come. And we're trying to prove that out in Australia. But by no means nailing it, but we're trying to. And hopefully, if we can crack this and demonstrate what's capable, we unlock the land sector and we take a huge amount of abatement for us and other nations who need to.
So I think I often say that trust is the lubricant in this market. And when we look at trust, and I agree with Matthew, it's not just one of those things, it's all of those. If I look at the different stakeholders, the big groupings that we have, governments have to set policy direction, and we've all said it now, clear direction, so it removes that uncertainty in the market. Then you have the buyers and the investors that need that certainty so they can invest. And they also need to be able to trust that the market's delivering high quality credits. So we need bodies like the various bodies that are setting the principles, that are testing the methodologies, that are looking at the standards and looking at that quality bar. And so between the governments and between the investors, we have the carbon market system, which include ourselves, like the registries, making sure that our standards, our methodologies are meeting the highest quality, but that you trust that registry infrastructure as well. And so building that market infrastructure, having the digital platforms that work, having a system you can trust, actually helps that whole loop so that the investors feel that they can buy high quality credits that are backed by very strong government backing. And it's this interdependency that drives this market. I'll tell you a little anecdote if we have time. So when I arrived in Singapore, I'm based in the US, my US credit card was not accepted in the taxi. For some weird reason, they said it was blocked. The taxi driver said to me, "It's fine, I'll drop you off at your hotel and charge you later." I said, but I don't even have Singaporean cash on me. He said, "No, it's fine. We have your email. I trust that you will pay it." And so I was a little gobsmacked, but he dropped me off and later on sent the email, so I paid them. My credit card's working now. And I thought, you know why? It's because the system here works, and people trust the system works. Obviously, the guy had to trust me as well, but the system works that they had my email, they knew it emailed me, I get the receipt, and I would pay them. And I think that's what we need. We need the system to work so people can trust that you can buy credit, it has high quality, that you can trust that the government has a policy in place that drives that high quality. The system has to work. So I think you need all of those things to work.
Since I'm probably standing between everybody here and cocktail hour, I
One more panel.
oh, there was over a panel? Okay. All right, then I'll take my time. No, there's nothing more to add. I think you two have really covered everything, and you know, it's confidence and it's stability, and we have neither right now, and we should, because we have all the tools that we need to have confidence in the market and have stability.
If I could summarize, right? And I keep probing on price signals, right? We need higher carbon price. Yeah. But it's beyond that, clearly, from what the panelists have said. It's about trust in the system, confidence, a design that actually is durable, works, and can deliver the abatement and the trajectory towards where we need to be. And there are many modalities, whether you keep it within domestic system itself, whether you open up to international carbon credits, but there are many pathways towards the same goal, which is net zero, and not absolute zero. Yep. With that, I thank the panelists for a very engaging discussion. Please join me in giving them a round of applause. Thank you.